Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 5th. S&P 500's at 3890. I'm David Zarling, and I'm here with the man who understands wordless punishment, Ian McMillan. Lots to cover this week. As far as last week, topic du jour was GameStop, and we can touch base on that again this week. But really, we should probably talk about new all-time highs, because that's about the most bullish thing a market can do. Unless you want to start somewhere else, Ian, should we start there?
Yeah. Well, I'll say wordless punishment. If you were raised with a father who chose silence as his form of punishing you, then
it's a beautiful thing.
It is. And my father listens to this podcast every week, so I thank you for that. And
I look forward to meeting him because I have much admiration for that style. So very awesome.
But yeah, new all-time highs. I mean, I think all major indices back again, hitting all-time highs yesterday. I guess the Russell hit it today, or the Dow hit it today, but the Russell, NASDAQ, S&P yesterday, a strong uptrend continues.
Right. Like you said, new all-time highs, Russell, S&P, NASDAQ, Dow Jones. It's the most bullish thing a stock or an indice can do is make new highs. And it's interesting you mentioned Dow Jones, because I had to pull up a relative chart of Dow Jones versus S&P, and of course that's making
horrible,
relative lows. So S&P and NASDAQ and Russell continue to be a major theme and focus.
Yeah, this week alone. So we had, I think the S&P finished January down, I think 1%, but this first week of February, they've all bounced back. Again, Russell leading the way up over 7%. NASDAQ up 5.5%, S&P up about 4.5%. So a strong start to a seasonally weak month. So we'll see where we are in 3 weeks.
Yeah, got to let the month close out. We had a January. We were talking about January barometer that we had a negative January. So we'll see what the rest of the year looks like. 2 out of 3
with our January kind of sentiment indicators, I guess, or at least seasonality sentiment. I don't know if that's a thing.
Yeah, we could call it that today. For sure. You had the Santa Claus rally positive. You had the first 5 days positive. January as a whole is negative. We'll see how February plays out. Obviously, we aren't able to predict what's going to happen in February, but it would be notable that if the weakest month out of the 6-month period, especially in a post-election year, is positive, that would be notable information and something to pay attention to. Last week we did talk about GameStop, but we also talked about how we'd seen some weakening breath, how maybe in Adaptive we were holding more cash than we had in a long time, but we were also able to use that to an advantage and deploy more cash this week, right? Because last week we talked about rising 50-day, rising 200-day.
An asterisk there, and that for us at least, higher cash is not, that doesn't mean exposure
100% cash
was
right.
Yeah, and it doesn't mean exposure. So exposure was at 97%.
Right.
Quickly, as clients know, did jump back up on Monday, although Monday was a very good day relative wise.
Yeah, no, I think.
I was then able to basically deploy all of it over Monday and Tuesday, and we end up, hitting new all-time highs yesterday. So,
well, and just as we were on the verge of seeing, saying, hey, we might see an environment where we have large cap growth take over because we're seeing weakening breath, which would match that. So we had the weakening breath, but then we had like an 80% up day on Monday.
Yeah.
And then we continue to see, as you alluded to, Russell outperform. So that's broad participation. So these are all healthy characteristics to coincide with new all-time high. I mean, I can't think of anything more bullish than something making all-time highs.
Bottoms, I guess it would have been Friday, and then Monday, kind of this like island reversal look on shorter time frame charts, and has continued to just grind higher all week. 38.90 energy and financials, right? So to be expected when you see the Russell leading, energy, financials, communications having a good week. Basically, that's from Google.
Right. I mean, those are all quality things. And last week we talked about rising 50-day daily moving averages, or whether you want to call it a 10-week moving average. Also seeing the same thing, rising 200-day, rising 40-week. Those are characteristics of uptrends, and accumulation by institutions near a 10-week moving averages should not be surprising. And that's kind of what we saw this week, is a resurgence of upside participation on Monday. We're seeing areas like banks and energy participate, which is helping small caps overall. Meanwhile, growth is still holding up.
It is. It absolutely is. I think we talked about Google.
Right.
Now, Apple still seems like it's trying to figure out, we're still hanging around this like 137 level. But the big mega cap stock names, Amazon seeing a nice rebound today.
Another topic from this past week that was notable is someone like Jeff Bezos stepping down as CEO. It's going to be later this year, but I'm sure some people are automatically assumed, oh, that means they're going to sell off Amazon stock. That hasn't been the case.
Yeah. And mega cap growth in general has outperformed this week.
Using something like MGK.
Yeah.
Yeah.
Facebook probably still the weakest of the typical FANG names.
Well, and that's an interesting one with Facebook, because you could also lump that with in the social space. We continue to see social make new all-time highs on a relative basis versus S&P 500. And that includes more things than just Facebook. You've got Twitter today making highs that we haven't seen since 2014.
Wow, really? I
Right.
haven't seen that.
Yep. That's a pretty healthy characteristic, to be making new 7-year highs and seeing the overall broad indices doing the same after testing broadly, whether we're talking about S&P 500 or the Dow Jones or those type of things, testing rising 50-day moving averages.
They bottom up quick on Monday.
They did.
They did. And I think it's another more proof that this market is really strong. I mean, to have the 4 to 5% dip just to see demand rush in.
Right. And can we use a phrase like, what do you think about this phrase, Ian? Strong and jittery. And what I mean by that is just the amount of money that bought puts last week or tried to pivot short quickly was pretty substantial. When we look at something like Macro Charts puts out good charts, and just talking about skew between calls and puts, and that hitting a level that is pretty, it doesn't guarantee a low, but historically we've seen lows appear during that period. So was last week a significant low, which is pretty incredible to think about that possibility when it was brief. We're talking about a 4 or 5% correction when we're talking about the S&P 500, and then that being reclaimed this week. But it seems like people are still waiting for that other foot to drop and the market to somehow collapse, even though we've had 2 major corrections in the past 3 years.
And Macro Charts also had another look. I kind of did a chart of this with looking at the VIX and the previous times we've been at the areas we were at as of last Friday's close, or the highs we reached last week, I guess.
Are you talking about like 37 to 40 in that area?
How usually those types of levels on the VIX are coming after a 10, 15, 20, 30% decline.
Right.
And yet we had a 5% decline. And Macro Charts had another good chart here where he said that this was the highest VIX ever for an S&P decline of 0 to 5%. And talked about how nervous the market was. And JC Peretz, I think, put it in a really simple way and said, to quote JC, does insurance get this expensive right before you're glad you had it? Or does it usually happen when the insurance wasn't necessary after all?
Right.
And I think that that's a great way of saying it. Like, it's very expensive to quote unquote hedge right now.
Yeah, with the VIX is
more expensive than it typically would be.
Yeah, with a high VIX, another way to think of high VIX is like high premiums.
Yeah, and you usually wouldn't see that, right? You would see people not wanting to hedge at all in a strong market, right?
Right.
There would be really no demand to buy puts or things like that. However you would synthetically want to decrease market exposure There's 1,000 ways to skin a cat in this industry. But again, if we want to call it insurance or, prepping for
Or protection,
another,
right? Because
yeah, protection. Absolutely. Usually it's pretty cheap when you're in a strong uptrend and no one's worried, right? Because if let's say you live in Florida, but you haven't had a hurricane in 5 years, your insurance is probably cheaper, right? Than it would be the months following a big hurricane.
yeah, well, and the cost of plywood, the cost of all your supplies that would have to do with a hurricane are normal and cheap. Same concept. But as soon as that hurricane starts bearing down, that stuff gets expensive, which is kind of what we're seeing now. Not that there has to be a hurricane that unfolds, but there's almost this like recency bias definitely unfolding where people think the next March is about to happen. March meaning like March of 2020.
I think it is recency bias to a T.
Well, look at what we talked about last week with shorting being really upside fuel when you've got a cover. And if you had a whole bunch of institutions pivot and add a bunch of shorts last week, well, this week's environment is causing them to cover. So it's further upside fuel. They are being caused to buy again. So we'll see. We got rising 50-day, 200-day moving averages to the upside. We saw expansion of breadth. Continue to see the Russell lead. Involves bank stocks. Another thing we talked about last week was the dollar. Can you talk about what we're seeing there?
The dollar has broken higher. So we talked about 90, getting above 91.
Correct.
Right.
Yep.
And then maybe getting up to like 91 and a half, 92 this week. We ended up getting to a little over 91 and a half, and they are selling it off today. We're back down to 91. But some shorter term strength, I guess, before today in the dollar. Haven't really seen that affect, like emerging market stocks too much. They've held in there on a relative basis.
And that's important information, right? If we've got a dollar that's near term strong and emerging markets holds up, I think that's important information. That's something you pay attention to and say, oh, okay, we're not seeing immediate sell off.
But still no major strength is still the base metals over the precious metals.
Right.
There is no really demand to own gold or silver.
Yeah, which is interesting. And I know that was another, whether we want to go back to the Wall Street bets, GameStop, that was supposed to be another pivot this week was towards silver to try to cause a short squeeze in silver. We'll see. But the dollar, where it is now, if we're breaking back below something like 90.75, could have a situation where that was a near-term false breakout that would cause the dollar to potentially move lower, which would take other things priced in dollars, Ian, potentially higher. What are some of those areas that we see, whether it's traditional or non-traditional areas that are priced in dollars? What are we seeing out of those?
Well, at least here for us in America, we price our Bitcoins in dollars.
Mm-hmm.
So that would a weaker dollar would be a tailwind for Bitcoin. I know that there's other macro or fundamental things that can drive Bitcoin, but just as it was a big tailwind in 2017, I'm not saying that we're going to have another rise of 2,000%.
Well, but when we look across the crypto landscape, whether it's Bitcoin, Ethereum, you name it, there's a lot of things that are setting up in crypto land, if I can call it that.
Pratty really likes digging into these. He's had some great charts, like the Ethereum breakout.
Ethereum's pretty impressive. Yeah, that's a pretty impressive move and breaking to new highs and having blue skies ahead of it. So we continue to see positive setups in cryptocurrencies or crypto assets, depending on where you come from and what you want to call it. Clients are familiar with Bitcoin. Another, let's call it old school liquid gold asset like oil. We're seeing that.
Yeah. Oil prices are going up again at $56 a barrel. It's a far cry from negative 40.
It is, and it broke higher out of this consolidation that was basically from first week in January.
A couple real nice bull flags it's broken out of. So bullish continuation, what we would expect to see.
And it's on an absolute and relative basis, right? It's not just...
At this point, there's a good possibility based on support and resistance, you could see crude oil get up to $65 here before the summer.
Yeah. And I mean, I don't think that's not a random
No,
number.
I mean, that's what with the highs we saw from in 2018 or 2019 and 2020.
Yeah, that's not a random number that you're just pulling out of the air as far as
$65 a barrel. I don't think that's totally, it has a lot of price history even going back before that.
And from long bases come higher spaces. And
yeah, and this is a very strong trend. Strong RSI continues to hit overbought. We love to see that.
And it's getting bought on a relative basis. This isn't just happening on an absolute. This is, these are price levels on a relative basis that we haven't seen since what Ian and I will call the reset back in March and April. When I compare something like oil versus the S&P 500, these are important price levels that we haven't seen for a while.
Crude oil futures from we'll call it what we now know as the November lows, kind of the November 9th, November 10th time frame. My birthday is November 10th, so I'm going to take some credit for bringing in some buyers. But crude oil has outperformed the S&P by 38%, and the S&P's had a good run since November.
It has.
But crude oil has gone from $32 to $56 a barrel.
Mm-hmm.
And bullish, right? I mean, that's typically a pretty bullish sign for the economy and the market.
Yeah. Okay, expand on that a little bit, because some people will say, oh, higher oil, that means my gas prices are going up and this is not good. What are you saying? I
think that I know that there's the argument that, this is going to hurt discretionary spending. One, I don't think we're driving as cars to work as much as we were last time prices were at these levels, right? I think most Americans can say they're probably spending less on gas at this point, at least if you had two parents that are working from home now. Maybe you're not taking your kids to school every day. So I think there's a lot less, but I think it's more of just, I'm not going to get on my economist soapbox here, but I mean, industrial use and just airplanes that use it. Like, there's a lot more uses for oil of people that have to use it. Like,
there's more uses for gas and oil than there is just
you
at
driving
your gas
your kid
pump.
to soccer practice.
Yes, and I think that's really where I was trying to get you pinned to, is that many people just relate what's going on.
I mean, American Airlines is going to fill up their plane. Maybe you might not take a road trip or go on that vacation because now gas is $20 more expensive, or you're not going to take the weekend trip or drive out to the mountains on Saturday, whatever. But it's not like American Airlines isn't going to fill up their plane that needs to fly from Chicago to LA because they don't want to spend too much on gas.
Or some construction project isn't going to happen.
Exactly.
So there's all sorts of economic factors. So when you see gas prices rise at your pump, don't necessarily think that's a negative. That could be a positive economically overall. So we don't look at rising oil here at Adaptive as necessarily a negative thing.
No, it's typically seen as a very, right? It's about industrial use.
Right.
Not is this going to hurt Sally from being able to go to the mall this weekend and buy a dress?
Right. Exactly. So we continue to see new 12-month highs there in oil on an absolute and relative basis. We're seeing all-time highs in indexes, equities. We're seeing that in crypto. We'll talk about oil as far as that'll be our touch base on commodities, but let's talk a little bit about rates and banks before we close out the client portion.
Continues to see strength. I mean, they went right back to banks this week.
Yeah.
So we're kind of seeing some resistance. So we're up at the December 2019. Like if we're looking at KRE regional banks,
right? Also
the resistance we saw in earlier January, but
we continue to see treasuries. Something like TLT making new lows that we haven't seen since the market reset back in March. TLT's at 148. That's not a price we saw.
No,
that's all the way back to March 18th.
Yeah.
March 19th. Those are prices we saw back then. So that's 2020. And so that's almost a full year ago.
Yes.
That we've seen that.
The long term, we'll call it intermediate term. This uptrend we've been in since 2019 continues to break down, right? And we would expect to see interest rates and treasury rates go up. They have, like you said, I mean, a 30-year treasury almost at 2% now.
Yeah, impressive. And that fits a little bit of the environment that we talked about in the past as far as inflationary. You would see rising rates, you'd see commodities.
And again, we're still in a 3-decade downtrend.
Yep.
So short of you needing to worry about interest rates in the near future, if you're buying a home, there's a lot of activity out there going on. The housing market is very hot
For sure.
because of low rates, right? And this mass movement, this work from home, blah, blah, blah. We all kind of see that that's going on. But yeah, rates continue to, I think you could definitely see them climb throughout the spring and the summer. There's really not much, resistance till maybe like 2.5, 2.4, 2.5%.
Right. And it doesn't necessarily damage the long-term downtrend, but it's a reversion to the mean. And and that affects certain areas of the bond complex, whether we're talking about floating rate, floating rate being a positive spot. We continue to see risk on areas of the bond complex or credit, whether it's junk bonds continue to outperform, make new highs versus the aggregate index of bonds. These are all risk on positive characteristics, high yield, junk. Even though treasuries are moving downwards, that doesn't mean all bonds or credit
muni
are
bonds
moving
very
down.
strong.
Exactly. So there's definitely risk on characteristics that we continue to see. At this point, Ian, we've bumped up against the end of our client portion here. As a teaser, I think we'll touch a little bit more on rates in the extended portion. We'll even cover GameStop again, and we have some other things that we can cover as well. But anything else you want to touch base on before we close down the client portion?
No, continues to be a strong market until proven otherwise. I think that while this run we've had in stocks since March, God, who knew that this is what we would come out of March with? But it goes back to, and I was thinking about this a lot this morning. Stocks are up anywhere from 80 to 100, 115% off of March. And that if you were not willing to participate in that, if you had some preconceived notion about the economy or politics or just worried that stocks were going to go down because of all the fear out there, these are the opportunities where your wealth creation and ability to meet those goals, you've got to participate. I just think that the last 10 months has been the best example of why you cannot think that you are smarter than price.
Yeah. The market knows
I don't
more
think that there's
us.
any technicians that are sitting around saying, "Oh, I saw this coming." Now, are most technicians we know participating? Yeah, because we're in an uptrend. We follow the trend, momentum. That's key number one.
And it's new highs.
Rule number one. So, but I don't know a single person who would have told you that the Russell 2000 was going to be up 130%. I certainly, there's no way that would have been anywhere on my radar. But you participate and you ride the trend and you are invested because the trend is telling us we need to own stocks.
Well, then doesn't that go back
you let it and you ride it.
Right. And doesn't that go back to having a plan rather than a prediction? Right? Like above certain price levels, be involved. Below certain price levels, reduce or not be involved. Yeah. Rather than trying to predict what the market's going to do, just let the market do what it's going to do. Don't tell me what the market's going to do. Show me what the market is doing, and then let's have a plan for that.
And I think it's just so unfortunate that people, because of what's going on, whether it's coronavirus again or politics or could be something in their personal lives, that they're upset, they're frustrated, and they just don't believe that the country or the world is headed in the right direction. And they want to go to cash. They want to be in treasuries. They're just worried. I mean, you've missed an absolutely once in a generation year-long run in stocks.
Yeah, and like talk about.
I don't think we're ever going to see I don't know if till the day I die, if I'll ever see the Russell 2000 up 140 or 135, whatever it's up in 10 months.
Well, and to your point, the whole hey, let's pivot to treasuries just because they're a bond. We're about
right? Because treasuries are safe, right?
We're about to close at a brand new relative low of TLT versus S&P 500, like in history. So,
but treasuries, they make it's backed by the government, and that makes people feel good. There's a lot of emotional tie to owning a U.S. Treasury, and this feeling that you won't lose money because it's safe.
right, and
as if it's like a CD or something you get at the bank.
Oh,
just not true.
Exactly, and if you had pivoted to treasuries at the pandemic crash, your opportunity you would cost yourself approximately minus 50%, right? Because you could have been an S&P, but you weren't. You were holding treasuries, and that's a tremendous cost to pay. So, Ian, great insights. We're going to dig more in the extended portion. Appreciate that. All those listening, we appreciate you guys. We'll do it again in a week, but I do encourage you to stay on for the extended portion. You guys have a great week ahead.
Have a great weekend, everyone.
All right, Ian, jumping into the extended portion of the podcast here. We spent quite a bit of time touching base on GameStop last week. I kind of want to revisit that a little bit and where we're at right now as far as something like GameStop is. And I guess maybe the first thing I want to touch base on is maybe what I would call a fundamental misunderstanding of supply and demand. And what I mean by that is one of the mantras of, if you want to call it, the protagonist movement that's looking to cause pain for hedge funds where they're going to just continue to buy things that are heavily shorted. The mantra would be, you got to hold, right? You got diamond hands, right? You got to hold on to that thing.
Diamond hands. Yeah. It's been a big one.
And that's not necessarily how it works, right? Because if everybody's holding and no one's buying, everybody's holding.
No one's buying, but people are selling.
Price goes down. And so
simple economics, really. No,
right.
I don't mean that economic term. I mean that again in just the mathematical
supply and demand. Economic law. It's not a theory. More supply than demand, price goes down. And so now we have a situation in our hands where anybody who purchased GameStop anywhere February, late January, early February is now in pain because we're now how much percent lower than the highs. We'll just nice round number, about minus 85%. That's real pain. And we've got stories coming out now of people who had put their life savings, a ton of money into something like into GameStop, that have lost $500,000. And I don't want to discourage people from investing or anything like that, but understand, and here I'm going to try to be careful how I do this. So a guy I have a tremendous amount of respect for because he's strong business savvy, very entertaining, super smart dude. I think he's got he already has a future. He's shown success already is a guy like David Portnoy. And he was a mouthpiece for this movement about hold. You got to be invested. You got to be buying these meme names.
I like Portnoy, but I agree on this one.
And then he sold. Because he's not an idiot. He's a smart guy. You don't hold things that go down to zero, or you don't hold things that evaporate 85% of your account.
It's true.
And so I think this goes back to, while I love the man, I think he's a genius in many different ways. Don't get that confused with him having your best interest in mind. Because he's got to do what he's
marketing. He's a marketing
right.
genius.
He's got to do what he's got to do, which means you got to do what you got to do. And so the whole idea that now next week, I don't know, maybe GME's up 1,000%, and we're having a different discussion next week, and he's back to owning it and all those different things. I don't. Who knows what the next week brings? I only know one person that knows what's going to happen next. But my point is, be careful of message boards. Be careful of Pied Pipers, if that's what we want to call them. Nobody knows your personal situation other than yourself, and if you have a good relationship with your financial advisor. And those are the two people that would work hand in hand and work in your best interest. The media doesn't know your personal situation.
Are you
Portnoy doesn't know your
implying that Dave Portnoy is not a fiduciary?
Correct. David Portnoy, as far as I'm aware of, is not a licensed professional.
CFP?
No.
He doesn't know my risk tolerance?
He doesn't know your risk tolerance. He doesn't know how much should be allocated. He doesn't know your time horizon. He doesn't know what age you are. He doesn't know any of those things. But while I get it's fun and sexy to talk about some of these meme names, and it is entertaining, and it does drive people towards investing. And in general, I think that's a good thing. But the whole idea that the mathematical equation of you need to have diamond hands for this to work might be a fallacy, a fundamental fallacy, because the idea that if everybody holds, this works is not necessarily true, because if everybody holds and only one person ends up selling, price goes down.
If you owned every stock and everyone held, it wouldn't work either, because the price. I mean, at some point with that theory, there's only, the stock can only go down.
Right. And so while I still think there's a place for discourse on a place like Wall Street Bets, and I still think it's
sure
notable and noble that people want to push back against quote unquote shenanigans, there's always two sides to a story. We talked last week about markets being a humble pie factory. We could even call them a house of pain. Right now, there's a lot of pain. There's real people with pain.
People are worried
because of advice they took from a message board. And so we all need to be careful out there. We all need to represent the industry well. That doesn't let hedge funds off the hook. I think as more information comes out, Ian, right, we can agree that it's likely, and you alluded to this last week already, it's likely that it just wasn't retail that affected some of these names. Like there was other demand going on here besides short covering and retail.
Yeah, I definitely think that there were some, I think Wall Street Bets, I think they were the first of the party. I think that they brought light to the fact that, like, whoa, there's a stock out here that's 130% short flow.
Right.
And congrats to them for being the first to notice it. And then, they started the fire. I think some bigger resources threw gasoline on that. And we saw what we saw, whatever. This is a dog eat dog game. Investing it's not for, fun. It's not picking flowers in a field all day.
No. It's the most competitive market on the planet.
It's extremely competitive. There are people with lots and lots and lots of money that have opposing ideas, and you see that play out in public markets, in the arena, the real arena. And there are times when two beasts are going at it and someone gets in the way. Someone stumbles into the cage somehow and gets caught up in it.
Yeah, and I just wanted
it's a big boy game. It's a big boy game. And unless you truly understand how everything works behind the scenes, what you don't know what these funds end objectives are. You can get really in over your head very quickly, as I think we've seen.
Well, there's just pain, and I hate to see it. And at the same time, we've talked about lessons learned, right? Whether it's a fender bender, crashing your bike, or it's something like this with stocks. You just hate to see it with someone who maybe has life savings. Just be careful out there. Connect with financial professionals that are licensed. Understand what the media is.
Have a plan to get out. I mean, some of the best things you can do is drive the car into the snowbank instead of heading out into the intersection.
Yeah. Risk management.
Exactly.
Absolutely. When things go bad, what's your plan? Are you going to head into oncoming traffic?
Maybe
are you going to ditch it
a little bit. Maybe there's a little bit of damage to the car.
Right.
But at least you know that you're going to stop it there.
Right. Amen, brother. So it'll be interesting to see how this unfolds in the coming weeks. I wanted to touch base on it because we are in a house of pain scenario where we are dramatically off the highs in these names like GameStop, COS, NOC, AMC, We're dramatically off the highs. The diamond hands hodl at this point is a lot of pain. We'll see if that moves higher in the weeks ahead, but I felt it was necessary to touch base on. But let's swing back to...
It's not the first time and it won't be the last time.
Correct. Exactly. It'll be interesting story to look back on towards the end of 2021 and see if it's still in play or if it was just a painful moment in time. We'll see. Time provides all sorts of information. Jumping back to rates a little bit, we talked about we're seeing treasuries fall, breaking to relative new lows versus the S&P 500. There was an interesting chart out there recently, and we talked about this. It was within the last 2 months on this podcast about, wouldn't it be something that when everybody was looking for a retest in stocks, right, coming off of the March bottom, what we now know is the March bottom, that we were going to get some type of retest, which means testing those bottoms or lower, which we never got, that we really should have been looking for maybe a double top in something like treasuries, especially when the narrative at the time was like the whole world's going negative. And when I mean negative rates. Now we've got an interesting chart out there, and I forget who it was put out by, but just the amount of negative yielding bonds. We're now seeing that.
I think it was Dietrich.
Ryan Dietrich, thank you. And seeing that break to the downside in a way that some technicians would call a false breakout, that now we could be seeing globally rates rising.
I think so too. And I think it would make sense that the U.S. was the one country that never made it to negative rates. I think if we look back on the situation, being, that we are seen as kind of the strongest when it comes, we're the reserve currency. We have really the strongest treasuries in the world. As far as, we'll call it actually being able to be backed by the government. And so I think it would make sense to see the U.S. and rates in general, start to turn up just that. Because there were, like you said, there were a lot of people that were making the argument that, of course, why wouldn't U.S. treasuries eventually have a negative yield if the rest of the world has? Why wouldn't they?
Right.
That was the common argument.
Yeah, we were even at a period where I believe it was like upwards of 90% of anything positive yielding from a credit perspective or bond perspective was in the United States, which is an extreme. And so now we appear to be upon reversion, seeing treasuries go to new lows, both on an absolute and relative basis.
And I would assume that just as foreign rates dropped faster and on an absolute basis went lower, when you talk about, actually being below -0, I would expect on the way back up, if this is a multi-month, multi-year trend, that these foreign rates will also rise higher than the U.S. over the coming months and years.
Mm-hmm. Which would also be an environment where you would potentially see international outperform.
Yeah, and I think then you need to start thinking about, well, do I want to own European financials over U.S. banks?
Yeah, and thank goodness we have relationships.
What does the inflation trade look like? I think we're seeing a lot of it begin. I know commodities obviously have gotten a lot of attention. Someone like Dan Russo has been on that trend for a while now, but you're starting to see, I think you see it in the energy sector, materials. There's certainly, again, we talk about it a lot, but this 2003 to 2008 type of market where growth underperforms now. Who knows, right? Technology just broke out to new relative highs this week. So, God, I mean, there's just so much strength. It's really hard right now, and it would really be something for tech to have the continued strength it has, but to even see the Russell continue to outperform the NASDAQ on top of that. I mean, you want to talk about a strong market.
Yeah, no doubt about it. That type of combination, a 1-2 punch. Pivoting a little bit, not too hard, but away from rates and this possibility of an inflationary environment. Let's talk a little bit about cannabis.
And that still remains hot. I guess it has something to do with like the Biden administration and some things they've said. I think that's kind of the fundamental view. All I know is that from a price perspective, we've been participating to continue to be very strong.
Well, yeah, you use an ETF like YOLO, and we're on the verge of
YOLO's up another what is this? 30% over the last week, 28-ish%.
Well, and we're on the doorsteps of a new all-time high in something like YOLO.
Yeah.
A pure cannabis play. There's plenty of different versions out there, whether you want to talk about MJ, but any technician should be going through the process of looking at a YOLO versus MJ and seeing where that's strength.
Absolutely. I think YOLO is the better bet there. Also amongst the individual names. I mean, there's been some names, you take IIPR, for example, that have been outperforming through this entire period of cannabis stocks underperforming, which has gone on for years. And we talk about, cannabis stocks, people forget, and I was having this conversation with Pratty earlier this week. I was telling him about the big cannabis run that we saw in 2015, 2016. And that's when a lot of these companies like Canopy and Aurora and Organ, these were all pink sheet. Those were all traded over the counter.
Yep.
And they were up, hundreds of percents. 900, 1,000, 1,500%. And then they took 2 years off.
Yep.
And it makes sense that now we could start seeing, right? And I would still, if you're using something like Canopy Growth, I would still consider this part of a 2-year consolidation. But I wouldn't be surprised at all to see most of these stocks get to new all-time highs.
Well, there's a lot when you look underneath the surface, and any technician can go out here and do this. They can go to Koifin and plug in YOLO, look at the holdings, and just go through the list. So many setups, so many charts setting up for the likelihood that supply outpaces demand in those names. It just
and I think that goes back right to how we operate. It's we are running scans on our ETF list that covers hundreds of ETFs from pretty much every corner of the investable market you can. And when we see an area, pick anything, internet, biotech, whatever, making new highs, well, then it's just like any other index. There's some that are going to be outperforming. There's going to be underperforming. Then you want to find the ones that are outperforming. It's very much part of the top-down process, as you said. If you take the top-down approach to cannabis, I think you'll see, again, as you alluded to, a lot of opportunity out there.
And it's information. Like, are we risk off if we're buying cannabis stocks? Like, no. That's probably not the environment.
Are we risk off if you mentioned earlier if high yield bonds are outperforming treasuries?
Yeah.
No. Or the broad bond market?
Oh, exactly. And so it's fascinating. And it's just the whole environment between, like we talked about, elevated VIX, higher premium for calls. We're seeing, SPACs, we're seeing IPOs, we're seeing broad participation retail wise, the GME situation, which, Eric Balkunas does a nice job just listing.
He does.
New ETFs that are coming out, just different fund flows that are notable. And he did a good job highlighting that there were some flows out of these meme names like GameStop and Nokia, et cetera, but then flight into ARK funds, which also made me think about, obviously we're a fan of Kathy Wood and she's done a tremendous job, but retail's also very aware of ARK funds.
It's a big story.
We get texts about that as well. And it just reminds me of a period, again, late 90s, the fund that was to be held at the time, the ARK of that era was the Magellan, was the Fidelity Magellan Fund. And here we are. Really? I think it's so poetic that we're in a similar environment, and the Fidelity Magellan Fund is now rolling out an ETF, FMAG. So it's just a beautiful wink from the market and different market environments to see ARK kind of be the retail spot just like Fidelity Magellan was back in the late 90s. And here we are rolling out the ETF.
And
for
when did Peter Lynch stop managing that fund?
Ooh, I don't have a good answer for that off the top of my head, but I know.
So he managed it. He retired in 1990. So that's had, I mean, even after his retirement,
Right.
It's had a good run.
Yeah, he had he did a good job putting together his team and the process, and
he actually took over managing that fund in 1977 at the age of 33.
And people don't realize that or they don't forget. There's definitely people in the industry, including Eric Balkunas, who pointed out, and he's absolutely right, that the Fidelity Magellan Fund was the fund to own in the 90s. It just was. Everybody was piling into that thing.
Is that one of those things where, like, if your advisor did not own it for you, they got fired?
Yeah. It was.
Like, how could you not own it?
How could you not own it? And it still has a strong track record over periods of time. And it's just hilarious that on a relative basis, if you looked at the mutual fund and compared to the S&P 500, so FMAGX, and we're retesting a breakout of highs. We've got the ETF being released. It's not investment advice. I'm not saying you need to go out there and buy FMAG. I'm just saying it's just an interesting time.
Cool, and I think it shows more and more the growth of the ETF industry. I love it. I don't think that there's any problem if it's outperforming.
Yeah, I think
why not own it?
Yeah, I think it's just it. Here's how I would put it. This weekend, we're going to watch the best new QB play against one of the great all-time QBs.
Yeah.
And it's very similar to now. Ark is that new QB. And here's Magellan, that old QB that still, has something to say. And now we've got a weekend with a Super Bowl on hand with those two guys playing. And I know what side you got. I know what side of the trade you're on, Ian.
Yeah.
And I'm excited for you. You got plans? What's the deal? What are you going to do?
We are staying home. So my wife is actually on Monday and Tuesday. She was all excited. What do you want for the game this year?
Like a menu?
Yeah, she's like, what kind of food do you want?
Okay,
food
that's
and drink.
great.
So what do you want? And I said that all I really wanted is I want some chips and nachos.
Yeah.
That was
buddy.
That was the only thing. And she was like, usually I ask, even during the regular season, we'll get like buffalo dip or I don't know. I think this year I'm feeling a little bit more nervous about it. I think last year I was still like, as a Chiefs fan, I was just happy to be there. And it was great when we, but like, and I'm a very serious, lifelong Chiefs fan. It's not that I didn't take last year seriously, but this year I'm much more like, all right, like let's try and build a dynasty. Like let's be the next Patriots. I think Tom Brady scares me. God, he's so good. Having to play Tom Brady really is not what I'm looking forward to. I think it's going to be a great game.
I think it's going to be awesome. As a football fan with no team in the game, and I know a lot of our listeners are Packer fans and they're going to be in mourning, and it's a hard pill to swallow, right? Tom Brady throws 3 interceptions in the NFC Championship game and still gets in the Super Bowl. But yet, you're right. I think it's just going to be an epic game. When it's the swan song for Tom, just a generational quarterback, and it's the emergence of Mahomes. It's a very hard to write a better story.
If Mahomes can knock him out, if Mahomes can beat him, I think it's the official passing of the torch.
Oh yeah, and I would even say
it'd be very poetic. I think it would be magical.
Yeah, it's just a great storyline. I'm looking forward to it. I know you are, and so enjoy those nachos, man. And I hope they're Super Bowl champ nachos. That's what I hope they are, and then you can
I hope they are too.
Rebrand them and sell them to all your Chiefs fans. All right, we have reached the end of our time. Appreciate all your insights. Anything you want to close with before we shut it down?
We talked about Magellan Fund. Actually, I think it'd be really cool if Fidelity Contra Fund came out with an ETF. That's another great fund.
That's another great one. Yeah,
it's an awesome fund. I'd rather, like, if I'm going to be overweight large cap growth, SPYG, I would just rather in the Contra Fund.
Yep. It's a good point.
So that'd be cool. But yeah, excited for the weekend.
Hey, you're allowed to say. You can say go Chiefs. You can say
The
it.
Chiefs, man, I'm excited.
You're allowed to be nervous. So, well, appreciate your insights. Appreciate the adaptive team this week and everybody at Client First. We got a new member on board and we're excited about that as well.
Higher tax season has kicked off, so it's super busy at the
Yeah,
office.
it's cranking here and it's fun. So Client First team is doing awesome. But appreciate you, Ian. Thanks for everybody who's listening and the feedback you guys provide. You guys have a great Super Bowl weekend, and we'll see you in a week.
Have a great weekend, everyone.